Hello, this is Edmund Shing from BCS Asset Management. In today's weekly update, we'll look at whether the market is in a bull or a bear trend for stocks and which sectors you should prefer. Firstly, the market. I don't think it's time to change my bullish market stance. Why? Firstly, yes, there are fears in the financial markets. We can see here that the Russian ruble and the Turkish lira have both depreciated quite substantially against the dollar since the beginning of January. So clearly emerging market fears have been on the rise. But here on page 4 we can see that US stock market volatility, I've used here the US midterm VIX index as a representation in black, has actually fallen back a long way from a height of 20 down to a reading of 15 at the moment. So the fear index is declining in the US. Equally, the average US stock, the line in black, is almost back to previous highs last seen in late January. So there already has been a strong positive momentum recovery in US stocks. And this is even more true in Europe. You can see from the yellow line that European small caps have actually broken out to a new high. The average European large cap stock, the line in black, is also breaking a new high at the moment. So the momentum in European stock markets is even stronger at the moment than in the US. Now, another way to look at the trends in stock markets are to look at other technical indicators. This black line at the top is what we call the advanced decline indicator and is shown on a cumulative basis. What this does, it takes the new rising stocks in the US every day and takes away the falling stocks. So the numbers going up minus the numbers going down. We then add this number up each day to have a cumulative index to get an idea of the trend. In this case, the trend is very strongly up. So the advanced decline index hitting a new high, underlining the strong positive momentum in stocks. However, on page 8 here, we see that from the Investors Intelligence survey of a professional advisor sentiment in the States, that people are not over bullish. The average advisor has actually become a lot more cautious. This is the line in black at the bottom. You can see it has fallen quite a long way. Their bullishness level has decreased and they have become more cautious. So no over-exuberance yet. So which sectors? Firstly, technology. The line in black has outperformed. So this is the tech sector in the US outperforming the S&P 500 index since the middle of December. A very strong outperformance trend which I see continuing because we still have to see further catch up of prices in black for the tech sector to earnings, which is the trend in green. Earnings have been very strongly ahead. Prices are still catching up. There's still some way to go to the upside. Secondly, healthcare sectors have been very bullish as well. This is a relative chart looking at US healthcare relative to the S&P 500. Again, a very strong relative upward move since the beginning of January, showing the outperformance which I see continuing both in the US for healthcare and in Europe. And finally, mining, which has been in a bear trend for a couple of years at least, has finally, as of late January, decisively broken out of this downtrend and is establishing a new uptrend. Companies such as Rio Tinto in particular are breaking out to the upside. They have low valuations and we are seeing stability in mining output prices with the potential, I think, for China also to stabilize their growth. In summary then, I remain bullish on the stock markets. I see no signals that we're going to enter a new bear market or correction. And the sectors I prefer to play this upside are technology, secondly healthcare, and thirdly mining in the US and Europe. This is Edmund Shing from BCS Asset Management saying goodbye.